On the morning of Friday, September 14th, 2007, customers began lining up outside Northern Rock branches across the United Kingdom before the doors opened. They were not protesting. They were scared. By midday, queues stretched around the block in several cities. Television cameras arrived. By evening, images of ordinary British savers waiting to withdraw their money had been broadcast around the world. The Bank of England had not seen anything like it since the collapse of Over Gurney and Company in 1866, 141 years earlier. The images were so unexpected that many commentators reached for a word that almost no living person had applied to Britain: bank run. Northern Rock began as a building society in Newcastle upon Tyne, formed in 1965 from the merger of two older mutual institutions, Northern Counties Permanent Building Society, which dated to 1850, and Rock Building Society, which dated to 1865. Building societies were mutual organizations. Depositors were members, there were no outside shareholders, and lending was straightforwardly funded by savings. In October 1997, as British financial deregulation made it possible, Northern Rock demutualized and listed on the London Stock Exchange. Over the following decade, it grew aggressively. By 2007, it had become, by many accounts, the fifth largest mortgage lender in the United Kingdom by new lending, with total assets that had grown to roughly £113 billion. The growth engine was securitization. Rather than funding mortgages the traditional way, by taking in deposits and lending them out in a closed loop, Northern Rock originated mortgages at scale and then packaged those mortgages into bonds it sold to institutional investors in global wholesale markets. The proceeds from each bond sale funded the next round of lending. A special purpose vehicle called Granite served as the conduit through which most of this securitization flowed. This approach, known as the originate-to-distribute model, was not unique to Northern Rock and was not illegal. It was mainstream financial engineering that British regulators had accepted across the banking industry. What distinguished Northern Rock was the degree to which it depended on this model for its very survival. The House of Commons Treasury Select Committee later reported that Northern Rock funded approximately 75% of its assets through wholesale markets rather than retail deposits, a far higher proportion than most comparable British banks. The mismatch this created was acute. Mortgages are 25-year obligations. Wholesale funding is rolled over on short cycles, overnight in the interbank market, weeks or months through commercial paper, quarters through securitization issuance. As long as investors kept rolling that funding over, the machine ran. When they stopped, Northern Rock had no way to replace the money fast enough to cover its obligations. The Bank of England's financial stability reports of that period flagged system-wide reliance on wholesale funding as a vulnerability, though no regulatory intervention constrained it before the crisis arrived. The trigger came from the United States. Through 2006 and into 2007, the American subprime mortgage market had been deteriorating steadily. Two Bear Stearns hedge funds that held large positions in subprime-backed securities collapsed in the summer of 2007. Then, on August 9, 2007, BNP Paribas Investment Partners announced it was suspending redemptions from 3 of its own funds, stating that it could not reliably value the U.S. mortgage securities they held. That announcement told the entire interbank market that no institution could be confident about the value of mortgage-backed paper on anyone else's balance sheet. Banks stopped lending to each other. The London Interbank offered rate, known as LIBOR, spiked sharply. The short-term wholesale funding market that Northern Rock depended on froze almost overnight. Through August and into September, Northern Rock's leadership searched for alternatives. Discussions about a possible acquisition by Lloyd's TSB took place but did not produce a deal, in part because the terms Lloyd's required from regulators were not agreed. The Financial Services Authority and the Bank of England were kept informed throughout. With its short-term funding pipeline effectively closed and no buyer forthcoming, Northern Rock formally requested emergency liquidity assistance from the Bank of England in early September 2007. The Bank of England's Governor, Mervyn King, had spoken publicly in the weeks before about the moral hazard of rescuing banks that had taken on excessive risk, arguing that such support could encourage recklessness in future. The Northern Rock request placed that principle in direct tension with the threat of an uncontrolled failure. The Bank of England agreed to provide emergency liquidity support. The arrangement was intended to be announced officially on the morning of September 14th. On the evening of Thursday, September 13th, 2007, the BBC's business editor Robert Peston reported on television that Northern Rock had secretly gone to the Bank of England for emergency funding. The report was accurate. Under British law at the time, no mechanism existed to impose a news blackout on such a disclosure, and no framework allowed the government to issue an immediate blanket guarantee large enough to forestall a panic before the news became public. The broadcast reached millions of depositors. By the time branches opened the next morning, queues had already formed. The House of Commons Treasury Select Committee estimated that depositors withdrew approximately £2 billion from Northern Rock in the 3 days following September 14th. The bank's share price fell sharply. Phone lines were overwhelmed. Some depositors reported waiting 4 hours or more. The run was not irrational from the perspective of each individual depositor. Under the Financial Services Compensation Scheme at the time, deposits were fully protected only up to £2,000, with 90% coverage on the next £33,000, giving a maximum protected payout of roughly £31,700 per depositor. Anyone holding more than that threshold had a concrete financial reason to withdraw the excess immediately. On September 17, 2007, Chancellor of the Exchequer Alistair Darling announced that the government would guarantee all existing deposits at Northern Rock. The queue stopped almost immediately. The government's contingent liability now covered the full balance sheet of a bank with roughly £113 billion in assets. A private sector solution remained the stated preference. Several bidders, including Virgin Money, submitted proposals through late 2007 and into early 2008, but none was accepted on terms the government judged adequate for taxpayers. On February 22, 2008, the Treasury announced that Northern Rock would be taken into temporary public ownership, becoming the first British bank brought directly into government hands in several decades. The House of Commons Treasury Select Committee published its report on Northern Rock in January 2008. The committee identified what it termed a tripartite failure. The Financial Services Authority had not challenged Northern Rock's funding model despite visible warning signs in its accounts. The Bank of England's framework for providing emergency liquidity was too rigid and too slow to allow a quiet rescue before public disclosure triggered a run. The Treasury lacked the legal tools to intervene in a failing bank quickly or confidentially. The committee concluded directly that the regulatory and statutory architecture in place at the time was not designed for a crisis of this kind, and that its shortcomings had turned a manageable institutional problem into a public spectacle that deepened the very panic the authorities were trying to prevent. The Northern Rock episode drove two significant legislative responses in the United Kingdom. The Banking Act of 2009 established the Special Resolution Regime, giving the Bank of England and the Treasury new powers to transfer a failing bank to a private buyer, place it into a bridge institution, or move it into a modified insolvency process without using standard court proceedings. The goal was to allow future bank failures to be managed quickly and, where possible, without the kind of public spectacle that had made the Northern Rock run so damaging. Separately, the Financial Services Compensation Scheme limit for deposits was raised in stages, to £50,000 in 2008 and subsequently to £85,000. The Financial Services Act of 2012 abolished the Financial Services Authority and replaced it with two bodies: the Prudential Regulation Authority, a subsidiary of the Bank of England responsible for the safety and soundness of banks and insurers, and the Financial Conduct Authority, responsible for consumer protection and market conduct. The tripartite structure that the inquiry had criticized was replaced with a model anchored directly to the central bank. Northern Rock illustrates a pattern that appears repeatedly in financial history, from Penn Central to Herstat to long-term capital management. A funding structure that looks efficient under normal conditions becomes a trap the moment market confidence shifts. Institutions that borrow short-term to fund long-term assets are exposed to liquidity crises even when their underlying assets are not, strictly speaking, worthless. The bank was solvent by one measure and illiquid by another, and in a crisis the difference between the two can collapse faster than any regulator or manager can respond. For individual depositors, the episode is a reminder that deposit insurance has limits, and that understanding what your national scheme covers matters before a crisis, not during one. In the United Kingdom, the Financial Services Compensation Scheme protects deposits up to £85,000 per person per authorized institution. In the United States, the Federal Deposit Insurance Corporation covers up to $250,000 per depositor per institution per ownership category. Limits and rules vary by country and are subject to change. Knowing yours is a basic piece of financial self-knowledge.